Sam's finger hovered over the mouse at 3:46 in the morning because the chart looked perfect. The breakout was clean, the volume was loud, and his brain was already spending the profit. And Sam felt that hot, familiar panic in his chest. He didn't lose money yet, not technically, but he could feel the loss coming, like thunder before rain. And that's the moment most traders never talk about, because it isn't about charts. It's about who you become when you're wrong. That's why Market Wizards by Jack D. Schwager is still one of the most important trading books ever written. It's a collection of interviews with elite traders who survived real drawdowns, real fear, and real uncertainty, and still found a way to win. You're going to learn the shared principles that show up across totally different styles. How the best traders think about risk, why most people sabotage themselves at the exact worst moment, and how to build a process you can actually follow when you're stressed. This video covers every major interview and the big lessons Schwager pulls from them, so by the end, you'll have the full picture. Sam didn't start out trying to be a wizard. He started out trying to be normal. He wanted a strategy that would just work. He wanted the market to behave like a math problem. If he did the right steps, he should get the right answers. Yeah, but the market doesn't care about should. The first lesson Market Wizards drills into your bones is that great traders are not the people who predict the future. They're the people who survive the future, whatever it ends up being. Sam learned this the hard way on a Monday morning, sitting at his kitchen table with a cold coffee and a warm laptop. He had spent all weekend backtesting a high win rate setup, and he felt proud of himself. He had numbers, he had confidence. He had that dangerous feeling of certainty. Then the first trade of the week went against him. He stared at the red number like it was an insult. He told himself it was just noise. He widened his stop. He added a little more size because his edge was supposed to show up over time. By lunch, the loss was no longer a paper cut, it was a gash. And the market immediately reversed in the direction he originally wanted. He slammed his desk. He didn't just feel unlucky, he felt targeted. Now pay attention to this because it connects everything we're going to cover. The traders in Market Wizards don't avoid losses. They accept losses, they expect them. They design their entire identity around handling them cleanly. Think of it like wearing a seatbelt. A seatbelt does not stop you from getting into accidents. It stops one accident from ending your life. The best traders treat risk management like that seatbelt. It's not optional, it's not for later. It is the system that keeps you alive long enough for skill to matter. Across the interviews, you see wildly different personalities. Some are quiet, some are aggressive, some are systematic, some are intuitive. But there's a shared backbone. They all cut losses. They all protect capital. They all respect uncertainty. And that's where Sam's mindset had to change, because most people approach trading like it's a talent contest. They want to prove they're smart. They want to be right. They want the market to clap for them. But the market is not impressed by your intelligence. It only pays you for your discipline. Here's the part nobody talks about. The first battle in trading is not against the market. It's against your own need to feel safe. In Market Wizards, you keep hearing variations of the same truth. You can be wrong a lot and still make a fortune as long as your losses are small and your winners are allowed to grow. That sounds simple. It's not, because your emotions hate small losses. Your ego hates being wrong. Your brain will invent stories to avoid closing a losing trade. Sam needed a new rule, and he found it in the way these traders talk. They don't ask, will this trade work? They ask, if this trade fails, what is the damage? That single question changes everything. Sam tried it the next week. He wrote one sentence on a sticky note and slapped it under his monitor. If I'm wrong, what happens next? He placed a trade and set a stop that actually meant something. It was close enough to matter and far enough to breathe. He left it alone. The trade went against him, it hit the stop, he took the loss, but it didn't destroy him. And the weird part is, he felt a small wave of relief, because for the first time, the outcome wasn't a surprise. He had already accepted it as a possibility. That's what the Market Wizards are really teaching you. They're not teaching you how to predict. They're teaching you how to respond. The top traders don't build their identity on one method. They build their identity on a process. A process is something you can repeat. A process is something you can measure. A process is something you can survive. Sam used to chase methods like he was chasing lottery tickets. One week he was a breakout trader. Next week he was a mean reversion guy. Then he tried indicators. Then he tried smart money. Then he tried copying someone else's entries. He was always starting over until it turned into another disappointment. Market Wizards shows you why that happens. It's because most people are trying to borrow confidence instead of building competence. The traders in the book don't need the market to give them confidence. They have confidence because their rules are stable. They know what they're looking for. They know what invalidates it. They know how much they can lose. They know what to do next. Think of it like cooking. A beginner stares at a recipe and panics if one ingredient is missing. A skilled cook understands the underlying structure. If there's no lemon, they use vinegar. If there's no thyme, they use something similar. The meal still works because the cook understands the role each ingredient plays. Great traders understand the role of each part of their system. They don't worship the exact entry. They respect the logic. And once Sam started thinking that way, he stopped asking for the perfect setup. He started asking for a repeatable one. Okay, so if that was surprising, wait until you hear this. Some of the most successful traders in the book talk like scientists, not gamblers. They test ideas, they track results, they adjust, they stay humble. That humility matters more than people realize, because the market has an infinite supply of ways to embarrass you. One of the core themes in Market Wizards is that arrogance is expensive. Overconfidence makes you oversize. Oversizing makes you fragile. Fragility turns normal volatility into catastrophe. Sam experienced that fragility on a day he still remembers in perfect detail. It was a Thursday. He had 2 monitors open. He had 2 notepad full of levels and a new sense of momentum after 3 winning trades in a row. He told himself he finally got it. So he doubled his size. The trade started fine. He felt proud. Then a sudden move slammed through his level like it wasn't even there. His loss doubled fast. Sam froze. His hand didn't move. His brain went silent. He wasn't thinking anymore. He was hoping. By the time he closed the trade, he had given back more than his last 3 wins combined. He sat there staring at the number, and he didn't feel angry. He felt hollow. That night, he opened and he noticed something he had skimmed past before. These traders don't just manage risk in the market, they manage risk in themselves. They know exactly what kind of day makes them reckless. They know what kind of win makes them careless. They know what kind of loss makes them desperate. And they build rules around that. Self-awareness is a trading edge. Most people think edge is purely technical. It is not. Edge is the combination of a method plus the ability to execute it under pressure. If you melt down under stress, your strategy is imaginary. That's why so many market wizards talk about psychology, discipline, and emotional control with the seriousness of surgeons. Now, there's another powerful lesson that runs through the interviews, and it's going to sound almost too basic. The best traders are obsessed with preserving their ability to play the next hand. They don't want one trade to define them. They don't want one week to erase them. They don't want one mistake to bankrupt them. Think of it like mountain climbing. If you rush the climb and run out of oxygen, you don't get a second chance. You don't make it back with skill. You just fail. The only way to reach the top is to survive every step. Trading is the same. Your job is to stay in the game. So the market wizards constantly talk about position sizing, cutting losses, and avoiding situations where one move can wipe you out. That includes leverage, that includes stubbornness, and that includes trading when you're emotionally compromised. It includes the hardest truth of all. Sometimes the best trade is no trade. Sam hated that idea. It felt like quitting. It felt like being lazy. It felt like missing out. But then he tried an experiment for exactly 14 days. He wrote it in his notebook like a challenge. No trade unless the setup is obvious. The first 3 days were torture. He kept seeing almost signals. He kept wanting action. He kept checking charts like a person checks the fridge when they're not hungry. But on day 6, something shifted. He noticed how many of his trades were not real setups. They were emotional reactions dressed up as logic. On day 9, he watched a market whip around violently and he did nothing. He expected regret. Instead, he felt calm, On day 14, he took one trade. One. And because he wasn't forcing it, he executed it cleanly. That's when patience is not passive. Patience is control. It's like holding a stretched slingshot. You don't release it just because you're bored. You release it when the aim is right. And that brings us to another major thread in the book. The best traders know what kind of game they're playing. Some are trend followers, some are discretionary macro thinkers, some are short-term opportunists, some are position traders with longer horizons, some are systematic. But the key is that they match their personality to their approach. This is where most people get wrecked. They copy someone else's strategy without copying their temperament. A calm, patient trend follower can sit through a drawdown and still follow rules. A nervous, high-energy trader might sabotage that same strategy by jumping in and out. The method is not wrong. The match is wrong. Sam had to admit that he was not built for certain styles. He could admire them, but he didn't have to force them. When he tried to trade too fast, he became impulsive. When he tried to hold too long without a clear plan, he became anxious. So he asked a better question. What style lets me be my best self? And that question led him to a hybrid approach. He wanted a clear framework, but with room for judgment. He wanted to trade fewer times, but with higher conviction. He wanted his rules to protect him from his worst instincts, without turning him into a robot. That's the kind of thinking Market Wizards encourages. Even when the interview subjects disagree on tactics, they disagree on indicators, they disagree on markets, they disagree on timing, but they agree on the deeper structure. They respect risk, they respect discipline, they respect the need for a real edge, they respect the need to keep learning. Stay with me here because this next idea changes the game. The Wizards don't rely on one source of information. They build a complete picture. Some of them study fundamentals, some study technicals, some study sentiment, some study inter-market relationships, some study positioning, some study the behavior of other traders. But they don't do it randomly. They do it to answer one question. Where is the opportunity and where is the danger? Sam used to treat information like entertainment. He would scroll headlines, watch clips, read hot takes. It made him feel informed, but it didn't make him accurate. So he built a simple routine inspired by what the best traders describe. He would begin each morning by answering 3 questions in his notebook. What is the market trying to do? What would prove me wrong? What is my maximum risk today? The third question changed him because it forced him to think like a risk manager, not a thrill seeker. And on days when he felt emotional, he would lower that maximum risk dramatically. He would trade smaller. Sometimes he would sit out completely. This is not about being fearless. It's about being intentional. Another theme you see across Market Wizards is the power of adapting. Markets change, volatility changes, participants change, regimes shift. The best traders don't marry a belief, they marry a process of finding truth. That doesn't mean they flip constantly. It means they pay attention. They listen to evidence. They are willing to say, I was wrong, and then act like it. Sam had a moment that felt embarrassing, but it taught him more than any winning streak. He had been bullish for weeks. He had reasons. He had analysis. He had a narrative. Then the market started making lower highs and failing to follow through, but he kept his bullish view anyway. One morning, he took a trade based on that view, and within minutes, it failed. The price action was screaming a warning. Sam ignored it because his mind was protecting the story. He took another trade. It failed again. Finally, he pushed his chair back, walked to the window, and just stood there for a full minute. He didn't feel confused anymore, he felt stubborn. So he did something new. He sat back down and wrote one line. My opinion is not a position. Then he flipped his bias. Not emotionally, not as revenge, as a response to evidence. He was aligned with the market instead of fighting it. Think of it like sailing. You don't scream at the wind for blowing the wrong way. You adjust the sail. And that flexibility is one of the biggest secret skills in Market Wizards. The books make it clear that great traders are not married to ego. They are married to survival and performance. Now you might be thinking, okay, so it's all risk management and discipline. There's more. Because you can be disciplined and still lose if you don't have an edge. Market Wizards forces you to confront the hard truth. You need a reason you should win over time. Not a vibe, not a feeling, not a hope, a reason. That reason can come from many places. It can come from exploiting a behavioral pattern. It can come from trend persistence. It can come from mispricings. It can come from understanding how other players are forced to act. It can come from time horizons where you can be patient while others can't. But it has to be real. And Sam did not want to hear that. He wanted a plug-and-play system. He wanted certainty. He wanted simplicity. But he realized that edge is earned. And here's the crazy part. Even when these traders have an edge, they still accept that any single trade can fail. They don't confuse edge with guarantee. They understand probability. They understand distribution. They understand that they can do everything right and still lose, and they can do something wrong and still win. That mindset keeps them sane. Sam tested this by doing something that sounded boring, but it changed his trading life. He started tracking his trades like a scientist. He recorded the setup. He recorded the market condition. He recorded his emotion level. He recorded whether he followed rules. After a month, he noticed a pattern that hurt his pride. His worst trades were not bad setups. They were good setups taken on bad emotional days. The entry was fine. The execution was poisoned. That discovery made him take psychology seriously because he could finally see the cost of ignoring it. Okay, so if you only remember one thing from this video, make it this next part. The Market Wizards show that the main job of a trader is to manage himself. The second job is to manage risk. The third job is to apply a method with an edge. Most people do it in the opposite order. They chase a method first, ignore themselves, and gamble with risk. Then they wonder why they keep repeating the same blow-ups. Now let's pull in one of the most powerful recurring ideas from the interviews. The best traders think in terms of asymmetry. They want trades where the downside is known, limited, and acceptable, and the upside is bigger, or more likely, or both. They are hunting for situations where the reward is not a little more than the risk, but meaningfully larger. That's what makes a small win rate strategy profitable, or a moderate win rate strategy powerful. Sam started asking one question before every trade. Is the upside worth the stress? That question saved him from so many bad trades, because some trades are technically valid, but emotionally costly. They distract you, they drain you, they make you obsess, they make you reactive. And the market wizards seem to understand that trading is not just a financial game, it's an energy game. If you spend all your energy on mediocre setups, you won't have the clarity for the best ones. Think of your attention like a flashlight with limited batteries. If you keep it on all day, by the time you need it most, it's dim. Now, another lesson that comes through strongly is that the best traders are students of their own mistakes. They don't hide them, they don't pretend, they study them. Sam used to avoid looking at his losing trades after the fact. It made him feel bad. He would close the app and move on. But then he read how these traders talk about losses. They talk about them like a coach reviewing game film. Not with shame, with curiosity. So Sam created a ritual. Every Friday evening, he would review the week and pick one trade that he hated. The one that made his stomach tighten. The one he wanted to forget. He would replay it and ask simple questions. Was my plan clear? Did I follow it? If I didn't, why? What would I do next time? Sometimes the answer was technical, but most of the time, the answer was emotional. I was tired. I was impatient. I was trying to make back a loss. I was feeling overconfident. I was bored. Once he named the real reason, the solution was easier. It was not find a better indicator. It was don't trade when I'm bored. It was reduce size after a win streak. It was walk away after 2 losses. And those are exactly the kinds of practical, grounded rules you see the market wizards describe, over and over in different words. And this is where Sam's story takes a turn. Because once he stopped trying to win every trade, he started winning more overall. That sounds like a contradiction. It isn't. When you stop needing each trade to validate you, you make better decisions. You let stops do their job, you let winners run, you don't revenge trade, you don't force entries, You become calmer, and calm is a competitive advantage. Now, you might also notice something else, but never absolute certainty. They'll say things like, I thought the odds were in my favor, or the market was telling me something, or I had a strong view, but they always keep room for being wrong. That humility creates flexibility. Jam, that flexibility prevents disaster. Sam started practicing a simple phrase whenever he felt too certain. I could be wrong. He didn't say it like a motivational poster. He said it like a safety switch. And every time he said it, he would check his risk. Is my stop placed? Is my size appropriate? If this goes against me, can I accept it? If the answer was no, he adjusted. Immediately. Now here's the part most people get completely wrong. They think trading is about predicting the next move. The market wizards show you it's about building a framework where the next move doesn't ruin you. That includes another overlooked skill, knowing when conditions are favorable for your method. A trend follower needs trends. A mean reversion trader needs oscillation. A breakout trader needs clean expansion. A discretionary trader needs clarity. If your environment doesn't match your approach, your edge evaporates. Sam learned to label the day. Is this a trending day? Is this a choppy day? Is this a news-driven day? Is this a low volatility day? That label helped him avoid forcing trades in the wrong environment. It also reduced his frustration because he stopped blaming himself for not performing in a market that wasn't designed for his style. Think of it like fishing. If the lake is frozen, you don't accuse your fishing rod of being broken. You change the plan. Another theme that shows up in the interviews is independence. Many of these traders became great because they stopped relying on the crowd for validation. They didn't need consensus, they didn't need social proof, they didn't need constant commentary, they used information, but they didn't become controlled by it. Sam had to detox from noise. He used to keep multiple chat rooms open, constantly reading opinions. But it also made him reactive, so he cut it down. He chose a small set of sources. He set specific times to check them. He stopped consuming commentary while in trades. The result was immediate. He felt more stable. He made fewer impulsive decisions. He started trusting his plan. That trust is everything, because when you don't trust yourself, you can't trade. You can only gamble. The difference between trading and gambling is a plan you actually follow. Now we're coming to the part where Schwager pulls the lessons together, and it's worth slowing down for a second. Because this is where the book stops being a collection of stories and becomes a blueprint. Across all these elite traders, Schwager emphasizes that there is no single magic technique. The magic is in the habits. The habit of controlling risk, the habit of cutting losses, the habit of staying disciplined, the habit of learning from mistakes, the habit of waiting for real opportunities, the habit of aligning your method with your personality, the habit of staying humble. Sam wrote these habits on a sheet of paper and taped it to the inside of his desk drawer. Not on the wall, not as a performance, as a private reminder. Because the hardest trading days are the days you don't want reminders. They're the days you want excuses. And here's the final transformation Sam experienced, which is also the real promise of he stopped needing trading to make him feel like somebody. He stopped trading to prove he was smart. He stopped trading to impress anyone. He stopped trading to escape his life. He started trading as a craft, a discipline, a long game, and it increased his consistency. Now, before we close, here are 4 things you can start doing right now based on what we just covered. The first is to define your maximum acceptable loss per trade and treat it like a hard boundary, not a suggestion. If you don't know what you can lose, you will always find out the worst way. The second is to build a simple journaling habit that tracks not just entries and exits, but also your emotional state. If you record whether you were calm, impatient, tired, or overconfident, you'll start seeing patterns that a chart alone will never reveal. The third is to create a rule for when you are not allowed to trade. You can base it on your mood, your recent performance, or time of day, but it must be specific enough that you can follow it. A rule like no trades after 2 consecutive losses, or no trades when I'm rushing sounds small, but it saves you from the exact moments where you are most likely to break your plan. The fourth is to define what your edge is in one clear sentence, even if it's imperfect. You might say you trade trends, you trade breakouts, or you trade reversals, but you need to know why your approach should work over a large sample. If you can't explain it simply, you're probably relying on hope. Once you have that sentence, you can test it, refine it, and build confidence that comes from evidence, not hype. That's it for this video. I hope it was useful and gave you something real to think about. Thanks for watching, and have a great day.